Well, okay, in a bit we'll move on to Cholamandalam.
Yeah.
Now, just to run you through the numbers, I mean, it's been a fantastic quarter for Chola once again. Whichever parameter you cut it, this quarter was all about whether margins will be squeezed or not. Guess what? Chola's actually increased margins. I was just, reviewing numbers as we start that conversation. Margins are at 7.8% versus 7.4% quarter on quarter. So even sequentially, there's a margin improvement. Business has grown, in a big way. Disbursements are up almost 11% quarter on quarter. The AUM growth is about 9% quarter on quarter. Obviously, year on year, these numbers are looking even more robust. And all of this is happening with very, very steady and stable asset quality. In fact, asset quality is improved. I mean, look at the gross NPA levels. They've come down to 3.5% versus 3.9%. So, I mean, it's just kind of hit all the check boxes on the green side. That is Cholamandalam investments.
Surabhi, the way they're growing, AUM now I think about 1.5 crores.
Yeah.
That basically means that it is closing the gap with the number two, the second largest NBFC, which is I think Shriram Finance, pretty fast.
Yeah.
It's been a stellar rate of growth. But I think we have the management to go to.
Yes, we do have Mr. Arul Selvan, President and CFO at Cholamandalam Investments and Finance with us. Mr. Selvan, thanks for joining in. We're just rattling off your numbers and all of them are looking so good. So let me start with business growth because, that's absolutely growing at, lightning pace quarter on quarter and year on year. Just tell us how your different segments are doing. And I just specifically wanted to know this new business segment that has shown the maximum growth for you. So what all are you clubbing under new business? And just give us contours of whether you're hopeful of sustaining this kind of growth. Loan book growth for FY25, what are you looking at?
We don't give forward-looking statements, you know that, but I think we have come to a stage where we need to give some indication. I think we will still conservatively keep it at the 20 to 25% for FY25 as a growth number. Factors that is keeping us, on a little conservative, state is to assess the monsoon and the election results as well as the liquidity positions because, we still have not full, clarity whether there will be rate reductions in this year. Well, there are more, expectations it will happen in H2. But as you know, the goalpost keeps moving. So, but we are working internally to keep our cost of funds low, as you have seen that, and you sounded it that the NIMs have kept improving. Cost of funds have come down, yields have improved, and we are making efforts there. On the growth side, yes, the new businesses are growing well, but these are more as a percentage terms, but in absolute terms, still the old business, which is a vehicle finance business, is the biggest contributor to the AUM growth. And the rest of the two old business or medium-term businesses, which were the loan against property and the home loans, have started really growing fast because they are making inroads into other parts of the country where originally they were focused mostly into the south and to some extent into north and west with respect to each of these businesses. So now they're making inroads across the country and we are seeing good traction. It's easy for us to grow in the other parts of the country because of our presence of vehicle finance branches and the knowledge sharing that is happening between the teams out there.
Right. Mrs. Selvan, hi, morning. You're saying 25% AUM growth broadly, right? For
yes,
25.
Right.
That's where you'd be.
Yeah.
Okay, we're hard pressed to find negatives in the results, so let me try one. No, maybe not negative. Opex went up substantially, Mrs. Selvan. Think about 60-odd% on a year-on-year basis, 20-25% on a quarter-on-quarter basis. Could you tell us what this is on account of, and are you opening branches at a very fast rate, and where will this sort of number be in FY25, if you can give us a sense?
Yeah, Opex has gone up because of 2-3 reasons. One is, as you know, we brought in the insurance income into our own fold, being done it through a subsidiary because of the agency license. So this is the first full quarter the insurance income was coming into Chola. So that related cost of Opex is going up there. The other part is also, yes, as you said, we have been increasing our branch network, and also the penetration of the loan against property and the home loans into the rest of the country, necessitates incremental manpower and branch costs to be addressed for. These were the major costs. Apart from that, in Q4 generally, because of good achievement levels, then we revise the incentive levels, etc., and provide certain incremental incentives, so that also adds to the cost of the in that particular quarter. Every Q4 you will see some amount of a slightly higher bump up on the Opex. Broadly, our Opex to asset ratio should be in the 3.1% range. That's what we target.
Okay. All right. Mr. Selvan, hi, good morning and congratulations. As you speak, in fact, the stock continues to move up. Now, two bright spots I wanted to focus you on. One is on the NIMs. They have improved by close to 40 basis points on a sequential basis. So good going out there. What is the broad band we should work with on the NIMs front? And also on the asset quality, how do you maintain such superior asset quality in a bit of a challenging environment as well? Is the best of asset quality behind you, or can you maintain these levels?
Yeah, so the NIMs will be at these levels. I would again conservatively put it, while we are making efforts to improve yield, predominantly on the vehicle finance side, because that is a fixed rate yield, and as we move forward, the contour of the portfolio changes, where the larger part of the book becomes the higher interest rate book, because during COVID we had a low interest regime, and that book was dragging down the NIMs of vehicle finance for some time. This will change in the coming quarters, so that would improve the yield. But the cost of funds, we will keep it at this level. There may be a slight increase also, because as we try to widen the scope of borrowing from relying purely on banks into ECBs and public debt and other parts of the borrowings, there could be some initial cost of funds increases. But I think between these two, we should keep the NIMs at the same level. On asset quality, yes, we have a full-fledged team. We have separate collection teams for each vertical individually, and these teams focus continuously only on collection, unlike some other industry players where sales and collections are merged. So they have their own reasons, but we find that at the cost of a slightly higher Opex, it makes sense to keep separate teams focusing on that. And we have a high amount of data analytics, supporting them to make this happen.
Mr. Selvan, on the NIMs part, you're saying that you're hoping to maintain NIMs at around 7.8%. That's a reasonable expectation to have for the year as a whole?
Yeah, I think we can keep it for the coming year, unless something new happens. As you know, there are always new surprises or shocks that could come. But given current scenario, as this situation continues, yes, it should. And if RBI comes with reduction, then it should improve, frankly.
Then it can get better. Yeah, who knows? If we start getting those rate cuts. The reason I was asking was that I was looking at the overall credit data. RBI put out the FY24 data, and that break that they put on NBFCs in terms of just credit optic, that is really showing up. System as a whole, from 30% credit growth to the NBFC sector, it came down to just 15%. So, just tell us a little more about how you're managing to keep cost of funds low, and what are your borrowings looking like, and how is the overall market? You're of course a top-notch NBFC, but just some more color on borrowing and what's going on in the market.
See, what also happens is a large part of our borrowing across the businesses is priority sector, focused. We do more, almost 85% of our branches are in the rural, and this caters to both the rural, which is required by banks. So we do a lot of securitization of priority sector assets. Even our borrowings are linked to priority sector on lending. So there we are able to negotiate tighter tighter cost of fund rates with them. So that helps us in containing our cost of fund. Actually, we don't play too much on the CPs. So that is why actually we were not impacted when CP rates went up over the last 2 quarters. So we keep our CPs at around less than 3-4% of the overall book, and so that we don't get impacted by the wild fluctuations out there. So these are our primary focus, and wherever we do, even when we did ECBs, when we our fully hedged cost is even lower than the bank borrowing cost. We try to target that way and take a longer negotiation time frame to get the rates right.
So just one more point since we're discussing, cost of funds. In general, the only issue that perhaps you can say is, a bit of a, gray area was the cost to income ratio moving higher. It actually moved up quite a bit. So, is that a one-off? Can you give us some guidance on the cost to income ratio that you're hoping to maintain?
That is, as I was saying, primarily driven by the Opex going up. We spoke about that. So that is what is driving the cost to income ratio. So it will, sort of even out as we move into the next year. But our cost ratios will tend to be higher. That's part of the way we operate, and that is a trade-off between the cost and the credit. Now, whether we reduce cost here and then increase credit cost, or reduce, spend a little bit more to pursue good credit quality, so that we make sure that credit remains absolutely, industry best.
Got it. So just one last question from my side, Mr. Selvan. On the sort of consumer and the CSEL segment, your delinquencies earlier there were kind of driven by this partnership with fintechs, etc. You kind of slowed down that substantially. Could you give us a sense of what happened in this quarter? What's going to look like in 25?
Yeah, see, as we spoke earlier, the CSEL business has got 2 parts. One is the traditional business, which is focused where we ourselves go meet the customers. It's not like an app-driven, etc. We meet the customer, we have a touch and feel of the business and lend to them basis our experience or interactions with them. So that business will continue to grow, and it is growing well, and it is also having a reasonably good, credit quality out there. The fintech businesses, we had a few instances of, bad experience with some of the partners we entered into. We exited them. That happened even in Q3 itself. So that is, but we have also been watchful of that, and we are trying to keep a little low profile on the fintech businesses. On the parallel, we have started our own app so that we could do our own business through the app for such similar customers, while we will pursue this fintech business with other partners where we have good experience.
Okay, very quickly, sir, your gross NPAs are around 3.5%, net NPAs are around 2.3%, multi-quarter good numbers out here. What should the guidance be? I wanted a number.
I would keep it at that level, while we'll endeavor to move it to better numbers. But I think what will happen is in Q1 it will slip a bit. It happens every time, if you go pre-COVID. But it is my guess. But of course, the teams will endeavor to keep it at the same level, if not better it. But generally, in Q1 it tends to slip a bit because there's a lot of push in Q4 to bring this down. But then we'll be better than this as we close the year next year.
Okay, thanks a lot, Mr. Selvan, for joining in. You're sounding quite positive about the outlook. The stock is up close around 4%. Congratulations on FY24. Looking forward to the numbers you've given us for FY25. We slip into a short break. You come back, we get chatting with the manager.